Thank you. Good morning, everybody. I know people are still trickling in, but we'll get started here, and I see the slides have popped all the way forward. I was just talking and found out the conference theme is Future of HR, and if anything's the future of HR, it's global mobility with people moving around borders more now than ever, whether it's immigrants coming here to work and how to deal with that, or sending people across over down to the US or across the seas to work. So part of what we're talking about today is transferring of employees and what it means to not only the company, but also them as an individual, what could happen and occur when they are moving across the border. So the first thing here is, one thing has really changed, and global mobility has existed for years. However, probably I would say the last 6 years, it really has blown up the amount of people that are migrating across borders to from Canada, and really borders have kind of dissolved. Like it's just people are aware that there's a world out there for different opportunities. But what hasn't changed is the framework around reporting. If anything, it's actually gotten more complex because the governments are putting in different regulations to try and make sure that they're able to capture everything. An example of that right now is Canada, CRA is auditing people through their CPP department when they report other employment income, because technically that's all subjected to payroll reporting. And so they're now using their CPP department to audit those people to say, what else can we possibly catch out of this? Even though most of them don't have Social Security, they're trying to find ways to capture things. So from that, we're going to continue to talk about, what does it mean to you guys as employers of people? And as I said, what does it mean to the individual who's actually crossing a border? So there's multiple areas that we're going to talk through, and you might think to yourself, well, why are you saying that? Why does it matter about the individual's tax residency? I just want to do their payroll. Residency has a primary driver, not only for payroll reporting, but also for the company and their permanent establishment, and what could be triggered if you have someone in a different country. So really, determination of residency is very important. We're going to talk a little bit about the tax treaty, and what it means for an individual if they actually are, if you're sending someone away from Canada, how could they be impacted by the Canadian departure tax rules? And then we're going to talk just briefly, just kidding, a lot about payroll and withholding, both for Canadian purposes and US purposes. So both Paula and I practice Canadian and US tax, so we speak both languages, if you will, even though it's English in both countries. And then we'll just talk briefly about the tax reporting requirements and what is needed to actually be filed, both from an individual perspective as well as a business. So I'm going to pass it over to Paula, who's going to kick us off, just talking about the residency.
Everybody can hear me okay? Yeah. Okay. It's really nice to be here, nice to see friendly faces, and we're excited, of course, obviously, to share our knowledge on these topics. Again, how Krista said, residency is really important, and it's a lot more complex than what some people perceive. Because if you do trip residency rules in the US, not only can it have implications for the employer, but maybe that employee also has private investments or holdings. Maybe they have a Canadian trust. Well, what does that mean then if all of a sudden they're a US tax resident and have obligations, compliance obligations, etc., on those personal things? So we'll talk about Canada first. Canada is a bit more subjective when determining residency. You can be a deemed resident if you spend more than 183 days in Canada, but it's really based on your facts and circumstances. So do you have a home here? Is your spouse and dependents in Canada? Where are your memberships, your driver's license, your health care? And so it's really important to think it through. If you have maybe one spouse that's been offered an opportunity in the US, and they decide, well, I'm going to go down and I don't want to pay tax in Canada anymore. I'm just going to file in the US. They can't necessarily do that if their spouse remains in Canada. They still have their home. They visit Canada a lot. Canada will say, no, you're still a resident here. So it's really important to talk to both the employee and their spouse if they're married, and just make sure that everybody is aware of what CRA views for residency. Residency is really important for Canadian tax because you are taxed on your worldwide income as long as you're a resident in Canada. And with the most significant being, do you have a home here, is your spouse here, etc. And the U.S. is a lot more objective. So it's, do you have a green card? Have you met the DAYS test? And their DAYS test is a little bit different. It's called the substantial presence test, and it's actually over 3 years. So it counts your current year work days, and then it takes a third of your prior year, not work days, total days, and then a sixth of the third preceding year. And if the total of those days is over 183, then under domestic law, you would be considered a resident of the U.S. And there's a lot of different options once you trigger that residency in the U.S., of course, of when you determine your first day or first day of residence on how you file your returns, whether or not, if you are married, you can file jointly in the U.S., that type of thing. So a lot of things to consider and a lot of opportunities there to plan if you are departing Canada, becoming a non-resident and moving to the U.S., that you need to be aware of.
Yeah, and I think, one of the first things we always ask when we're doing a briefing with an individual that's going to be moving across borders is we get to understand their family, and that's why it's generally a one-on-one call without the business there. We understand their family, we understand their assets, because it's not, a lot of times it's not just their pay. There's a lot more components that potentially could go into seconding someone down to the United States or to another country, or bringing someone up to Canada, right? So one of the very first things we're always determining is residency, because that will drive, as I said earlier, just everything else when it comes to the employee, for payroll, for tax, for foreign reporting that might exist already. So this is why we talk about it first, is because it really does drive everything else when it comes to the employee moving across a border.
Yeah, the foreign reporting especially can be very punitive if it's missed in the U.S. So once you do become a resident of the U.S., of course, there's reporting of your bank accounts. If you have a corporation in Canada, there's additional reporting. So definitely want to be proactive and not reactive. The worst situation is when an employee has already left and is situated in the U.S. Then you run into, okay, well, how can we fix things, mitigate the tax exposure as much as possible, but your planning opportunities are substantially reduced at that time. And we do really like to have a bright line test if somebody is departing Canada. So especially if they're married and have kids and dependents here, you just want to really think of, okay, when did they actually become a non-resident of Canada? When is that residency starting in the U.S.? And that kind of speaks to the next slide, which is on the treaty. So if a person is considered a resident of both countries, so under domestic law, they're considered a resident of Canada, U.S. a resident of U.S., you would look to the treaty to decide which country actually gets to tax the person as a resident. Of course, if you're a U.S. citizen, their rules are different. You're taxing your worldwide income regardless of where you live, but the treaty has articles in there to mitigate any double taxation for a U.S. citizen. But for example, if you're a Canadian citizen moving abroad to the U.S., we would look at the articles of the treaty, and it's a series of tests. The first test being, where is your permanent home? If you no longer have a home in Canada, you just have a home in the U.S., that's the end of the test. You don't go further. You'd be considered a resident of the U.S. going forward. If you have a home available in both countries, which is often the case, a lot of people will have a vacation home that they want to keep in Canada. They don't want to sell that. Then you have to go to the next level of test, which is the Center of Vital Interests. That's where your social and economic ties, so where is your spouse, dependents. It looks into where your memberships are, your healthcare, etc. If it's still gray on that side of things, then you go to the test called habitual abode. And that's really where are you spending your substantial amount of time, where are you sleeping at night, and where do you call home? There's a lot of case law situated around the habitual abode. It's not just the number of days test, but that does have a big bearing on that test, is where you're spending substantially most of your time. If it's still gray, then you go to the fourth test, which is citizenship. If you're a citizen of both countries, then it goes to competent authority, and we really try to avoid that. It can take years for the tax authorities to come to a conclusion if something goes to the competent authority.
Yeah, the competent authority is basically the two countries have to agree to who gets to tax this individual as a resident. And, you know, I think as part of all of this, when you're looking at permanent home, a lot of times it's not, as Paula said, not everything is black and white, because a lot of times you might send someone down to the US for a year and a half. Their intent is to come back to Canada and they've given up their home in Canada. That might not actually be enough to be able to have Canada agree. And Canada, 2 years ago, I think, started auditing this and sending taxpayers the form NR73, which was a determination of residency. Because they're trying to catch people both ways, people who have spent a lot of time out of Canada and are trying to avoid departure tax, but also catching people who are filing as a non-resident of Canada and reporting employment income because they have deferred salary or deferred bonuses that they have to report, and getting them to fill one out to determine their residency to see if they're actually a non-resident of Canada. And I've had 2 instances, well, one right now, where we were disputing with CRA for a year about residency, and we finally just got a letter saying, go to competent authority. Like, they basically said, we're not talking to you. You can go to competent authority, and they've kind of washed their hands of it, which we always try to avoid competent authority. So it is something I know Canada is much more strict on. The US, obviously a larger population, don't pay attention to it nearly as much, but that doesn't mean it won't happen.
Yeah, that's right. And just to be clear, like, a permanent home doesn't mean that you need to own a home. It can be a rental lease. It can be even a space in somebody else's home. If you have a space available to you, that can be considered a permanent home. Okay, so if you do become a non-resident of Canada, this might be a topic that you guys are aware of. Your departure tax comes into play. This is also a really important topic because if you have employees coming into Canada, they need to be aware that departure tax will come into play once they leave Canada and return to their home country as well. So what is this? Departure tax, there's a deemed disposition on the date that you become a non-resident of Canada. So the fair market value of your assets becomes the deemed proceeds, less your adjusted cost basis, what you paid for the asset. And if there's an unrealized gain on your total assets, then you have to pay tax on that. There's a lot of exemptions. So if you have real property in Canada, it's not included in this rule. Any registered accounts are not included, TFSA, RSP, RESP, etc. So it really, like, non-registered accounts is a big one. So your securities that you trade. And if you have, this is when you might not be aware of some of the situations that your employees have. So maybe they're an owner of a private company, or they have private shares or a limited partnership, or and a trust or something that would fall into these rules. So the tax is due when they file their final return. So if somebody was to leave in January of 2026, the tax would be due April 30th, 2027. But it can be daunting if somebody has a large portfolio in their non-registered account and is not expecting this, then this can be an issue. We say that it's not as worse or it sounds worse than it is, because there is some planning that you can do to mitigate the tax. For example, maybe you leave Canada really, really early in the year, so then your marginal tax bracket is lower because you don't have additional other income that would increase your tax bracket. You can post security with the CRA to actually pay the tax when you sell the asset. Just depending on the amount of tax that is owed. Sometimes you can just file an election and you don't have to post security, but if it's over a certain threshold, then you do have to give collateral to the CRA when you're posting security. So an example of that would be a letter of credit from a bank, or if they're personal shares, you can even post your private shares with CRA. It's a very timely process to get all that completed and organized with the CRA, but there is that opportunity. And then also with the US and the treaty, there's elections that you can make to have the capital gain realized for US tax purposes as well. So down the road, when you actually sell the asset, you're not double taxed essentially. So your cost basis would be bumped up for US purposes. Trying not to get too technical here, but this is a really hot topic that we would dive into with your employees if they were leaving Canada, because it's just something really that needs to be aware. And for people that are moving to Canada, there's also an exemption that if they leave Canada within 5 years, 16 months, then any property that they owned prior to arriving to Canada is excluded from the departure tax too. So if they own that beautiful condo in Hawaii, that's really appreciated. As long as they leave Canada prior to that 5 years, it won't be captured by this rule, which a lot of executives really take note of this and plan their stay in Canada accordingly.
Yeah, and it's, it's interesting because there's a lot of things that Canada still, even if the person leaves, they get the right to tax forever, right? So their home, if they continue to own real property here. The other one that often comes up is deferred compensation of some kind, whether it's stock options, RSUs that are unvested. Those will be trailing forever, that Canada gets the right to tax it if the work days are in Canada, and you have to do a kind of a proration of total work days of the period times what was in Canada, and Canada still gets to forever, even if the person's left Canada, get the right to tax that. This is more the intention of departure tax is for Canada to be able to capture the tax that they would have otherwise been able to collect on appreciated assets, but no longer get the right to tax because the person left to Canada. So that's the main intent behind departure tax, and the US has a similar regime called exit tax. And so a lot of countries have that because they don't want people coming here, appreciating a bunch of assets and then leaving to avoid tax, right? So it's the whole intent behind it is to just tax appreciated assets that they, for some other reason, wouldn't be able to tax in the future once they're not a resident.
Yeah, I agree. So there's a lot of other forms that will need to be filed with the employee's tax return for departure tax, et cetera, but we won't go into those details. Okay, so what if they want to maintain a home in Canada? This is also very common. For example, that vacation home at the lake that they've spent so much time at, and their family holidays are situated on that. It's definitely something that they don't want to give up. So we do recommend, if it's not a vacation property, if it's not normally habituated, that they rent the property. So if it was the personal residence in a city, the best way to just make that bright line test, depart Canada with less gray, is to rent that property to a third party. So if you do that and you're a non-resident of Canada, you still have a filing requirement in Canada for Canadian source income. So rental income of a Canadian real property would be a Canadian source income. It's great if they can use a property manager or somebody in Canada to help with this, because they do have to have withholding tax withheld on a monthly basis and remit that to CRA on the rental income. And then at the end of the year, you file a tax return, you get to claim your expenses, etc. But the other issue is if they decide to sell that property as a non-resident of Canada. So Canada, like Krista said, it's property situated here. It's not subject to the deemed disposition rule. So when you actually sell that property is when Canada gets to the right to tax it. And because the person is now a non-resident of Canada, there will be a withholding tax on the proceeds. If it's a rental property, it can be up to 50% of the proceeds actually that needs to be held back. And then you need to file within 10 days of the property selling closing date, a clearance certificate with the CRA saying, well, wait a minute, actually I lived in this place for so many years, this was my principal residence. My capital gain is actually a lot less than the proceeds that I'm receiving, and this is the actual tax I'm gonna owe on the property. So then once CRA processes that form, they'll let the lawyers know, and then the lawyers will release a portion of that fund and remit the actual tax to the CRA. This is a very slow process with CRA right now. It's supposed to take about 12 weeks for them to process these forms, and I would say it's taking 6 to 9 months right now. So, which is a really long time, especially if people are counting on those proceeds to buy another property, etc. So just something really important to be aware of, and to ensure that that clearance certificate is filed. And then also there's the new taxes that are coming. It's not really in Alberta, but BC, Ontario has the BC speculation and vacancy tax. Ontario has similar tax. That if you are now not a resident of Canada and your house is empty, then you could be subject to these taxes, which is generally based on the fair market value of the property and can be a bit of a surprise if you're not aware of how you can mitigate that. So either renting the property, for example, etc.
And thankfully, the UHT's gone.
Yes.
Thankfully.
The underused housing
the federal
tax.
one, yeah.
Yeah.
It was just a couple months ago they decided to get rid of it. So that's good because it was a pain.
Yeah. So, I think that's...
Yeah,
that's
so
all
the main
say.
thing about all of this first part about residency treaties is, when an employee is going to be moving across a border, sometimes they can get pretty stressed out. Not only are they going to a new country, sometimes it's a country where culture is different or language is different. When you have the stress of all of this stuff as well, it can create a lot of anxiety for individuals. And so for the most part, we try to do briefings in advance of the move to be able to advise them, be prepared for this and be prepared for that, so that when things do come up, like they have to wait 9 months for a clearance certificate because their house didn't sell till after they left the country. It's things like that that can help to alleviate different secondments that happen and to create a better experience for the employee as they're moving across countries. So we'll pop over a little bit now to the payroll side of things, and I'm gonna break this down into 2 different categories, the short-term and the long-term type of payroll, and looking at it from both, if it's a person coming from Canada to the US versus US to Canada, because they are different, basically. And so when you're looking at a short-term assignment, we go back to saying, okay, if it's a short-term assignment, they likely are gonna remain a resident of their home country, which means if you have a Canadian going down to the US, if they remain Canadian residency for the period of time in which they are down in the US working, there is still a requirement to do Canadian payroll withholding under Canadian law because they're a resident of Canada. However, a waiver can be applied to reduce said withholding for whatever they're paying to the other country. This, I would say, is missed, unfortunately, probably more frequently than it should be. And the reason is because people don't actually dig in to say, have you kept your Canadian residency? So as Paula said, maybe their wife stayed behind or their husband, depending on who went. If that's the case, likely under the treaty, they may not have been able to break to their new home country. And so under the employer's Canadian law, they have to still continue to issue a T4 for that individual because they're a resident. This does get missed, and so it's something to be aware of on short-term assignments, that you're always making sure you understand the individual's tax residency before updating how you're going to manage the payroll. Vice versa, if you have a US person coming to Canada on a short term, they would have to stay on US payroll, and you would also do Canadian payroll. So in both instances, usually what will happen is the host country will do a shadow payroll, issue for the amount of taxes down there. They'll withhold what's called hypo tax to be able to pay the tax into the system. And then the difference, like in Canada, the rates are generally higher, so you have some actual tax that has to be remitted to CRA, and the rest will go to the host country. So it can get quite nuanced, and depending on what type of corporate structure exists, you determine who's actually remitting and submitting the different payroll taxes and who's doing the T4 and who's doing the W2, because then from that point of the perspective of the employee, they're going to get two slips that in general the home country would include 100% of the income. The host country would only include host country income, and then on the tax returns they report it accordingly to their slips. Now when it comes to long-term relocation, and if they're going to break Canadian residency, that one, the only time you would ever do a T4 is if they have trailing income. So as I said before, the stock options, the RSUs, potentially bonuses for a prior period. In those instances, you will still have to issue a T4 for that. And so you want to make sure you keep them active in your payroll system so that the next year, even though they're not in Canada, if there's trailing income, you're able to do the withholdings and remit and issue a T4. I think I talk about the Social Security on another slide. So for this perspective, when you're looking at Canada versus the US, and we do other countries, but I don't, so I'm just talking about those two countries. You really have to go back to where are they a resident, how long are they going, and then determine days. And some people still go back and forth. And so you actually have to go, okay, well, they're spending 70% of the time in the US, and they're still coming to Canada 30%. And if they're a resident of Canada, that's going to still be taxed in Canada, even though they're not working for the Canadian entity. And in the world nowadays where people are working remote, it's happening more and more and more, where people are in another country working, which actually puts the employer at risk. Because if someone goes, I'm going to go work to California for 3 months, hope you don't mind. Yeah, no problem, you can work from anywhere. You got your computer, cool. However, now that they're in California, congratulations to the employer, California doesn't follow the tax treaty. There is zero protection. Zero. And you've got payroll exposure. Now, chance of it getting caught, I don't know. I'm not an auditor, so I don't know the risk level, but you have to be really careful with your remote policies and people working in other countries, and in the US, not just in the US, but which state are they going to, because there's 12 states that do not follow the treaty. And so there is zero protection for the employee and the employer. And so you want to really be careful when you say, yeah, sure, no problem. You can do it from anywhere. I don't care. Technically, yes, but regulatory, no.
The other tranche of people is the business travelers. So you do really want to watch your business travelers as well, because the reporting requirements, the payroll, especially in Canada, still applies. You still have to do T4 slips if they exceed the thresholds in the treaty, et cetera. But yeah, like Krista said, it's where the boots are on the ground is for employment income is which country gets to tax that.
Yeah, so between Canada and the US, Article 15 is the treaty that section that protects income. And the general rule is if someone earns more than $10,000, so sourcing by days, if it's $10,000 or more, and it's borne by a US enterprise or by a permanent establishment, so if it's the Canadian entity with a permanent establishment, that also counts. If that expense is borne by them, that income is taxable, or 183 days, then it's taxable regardless of the dollar amount and who's paying it. The other thing for the company, just it's not on here, but to be aware of, is if you're sending an executive and they're spending, we had this instance recently where the CEO was spending half their time in the US, more than half actually. Oof. Well, now you've created a permanent establishment for the whole enterprise potentially, not just payroll, right? So there's a lot of things you kind of have to think of from a corporate perspective as well as the payroll perspective. And then, I mean, you can double click many times down the line. How does the benefits work? Are they covered by their health care? Under Canadian healthcare, if you're gone for 6 months, typically you don't get to keep your provincial healthcare, right? So there's so many things you kind of got to double click down the line when you're looking at sending someone on secondment. So the next thing here is just talking about the Social Security. Canada and the United States do have a Social Security agreement in which an individual, if they're going on what they deem as a short term, but it's up to 5 years, and you can get an extension, you can apply to stay on your home Social Security regime, which actually can be quite beneficial because under both Canada and the US, you have to pay into it for so many years in order to get money out. And that's the whole reason that this exists, is they're not gonna make someone pay into it for 5 years because they'll actually never get the money back. And in the US, it's substantially more money than the Canadian CPP and EI. And so even though income tax rates are lower, their FICA rates are higher, and if you're in California, you're almost paying as much tax as you would in Alberta, actually. So it's just paying it differently. So what we typically do if someone's going on a 5-year secondment is we will file for a clearance certificate so they can continue to pay into the Canadian regime. And in that instance, there'll be a non-resident of Canada, so you don't need to do income tax withholding. So you'll only file a T4 just to report the income and the amount of CPP that was withheld. And that's all that goes on it with a province of ZZ, so that Canada knows it's not taxable, and it goes from there, and vice versa. If someone's coming to Canada from the United States, they'll likely want to continue paying into FICA unless they say, I don't care about the Social Security, I'd rather pay less tax. They might say that. Generally, no, they want to pay into their home country regime so that they can get the benefit of in the future when they retire.
Yeah.
All right, tax filing requirements. So this says US tax filing requirements. It's basically the same for Canada, but we're just focusing on the US. There's 3 different types of returns that can be filed both in Canada and the US. It's either you're a full year resident, which means the entire year you're a resident, you're reporting your worldwide income, carte blanche. There's a dual status return. Canada calls it a part year return. And what that means is for the part of the year that you were a resident, you're reporting your worldwide income. And for the part of the year you were not a resident, you only report the income of that country that is allowed to tax it. And then finally, there is a non-resident. And a non-resident return is only filed if you have income that's reportable and taxable in that country. And so in the instances where we were talking about residency at the beginning, someone goes on a 1.5 year secondment, they're likely going to stay a resident of their home country, report their worldwide income, and then in their host country, all they're going to report is that US source employment income or bonuses or options or whatever they get for that period of time on that non-resident return. And that's all the host country gets to tax. They don't get to tax any other type of income of that individual. If a person is a full year resident, they have to do tax plus reporting plus anything else. So there's a lot of other things that can come into this once you become a resident of country. So that's why we started with residency, because it really drives every other decision that comes up thereafter for the individual. Do you have anything to add on that?
No, I don't think so. This just kind of goes back to my comment at the beginning that there's some planning opportunities, especially with the U.S. tax filing alternatives, maybe when you are going to move, and just the timing of realizing events. So if there's, you just have to consider that maybe there's something that's not subject to tax in Canada. You can't assume that it won't be subject to tax in the U.S., so maybe you want to trigger those events prior to leaving the country, just to ensure that there's no surprises.
Yeah, and when it comes to other type of compensation besides salary, allowances, the US has different laws than Canada. Options, depending on the vesting, could be different. You have different elections in the US than we do in Canada. And so if you have a lot of different type of compensation, not just a salary, the 2 countries do have significantly different rules when it comes to those that exist. If a person were to leave Canada, so let's say you're sending someone down to the US, as we talked about already, we somewhat covered this under the home. Canada still maintains the right to tax particular income, trailing employment compensation. Most of it's going to be captured under the non-resident withholding regime. The only three things that really require a tax return to be filed is if they sell real property, they have a rental property, or they have trailing compensation. In those instances, those are the three main areas where we would see someone still needing to file a non-resident Canadian tax return after leaving Canada. Otherwise than that, it's captured under the non-resident withholding regime, of which if they've advised their banks and advised everybody appropriately, they take care of it, nothing needs to be filed. So it's really a nothing for them if they've advised everybody. And these are the ones that are subject or eligible for the different withholding regimes. It's mainly passive income, if you will, things and pensions that exist that get caught by this. So you don't need to worry about capturing any of that going forward. So the foreign tax credit regime, this is where if you have individuals that are taxed in two separate countries for the same type of income. So this will come up a lot when you have US citizens in Canada, because as a US citizen, they're still required, even if they're not a resident, to report worldwide income to the United States forevermore. The foreign tax credit regime is there to eliminate double tax. And that's the reason, and it's actually probably one of the most important things aside from the tax treaty to protect people. However, you have to be really careful in how this is set up. I had an instance recently where someone was granted LLC units as part of their compensation because they got some equity of the US company. Well, an LLC for a Canadian person is not good. It can create double tax. So really when you're thinking about different things in how you're reporting stuff, the foreign tax credit is there to protect you 98% of the time. There's the 2% where it's, you don't get access because you have to be in the treaty to be able to get access to the foreign tax credits. And if you're not protected by the treaty, then you're really limited in how you can use the foreign tax credits. Whether it's, and California is a good example, where California will try to tax something because they can, they don't follow the treaty. Canada says, well, per the treaty, that's actually Canadian source. No foreign tax credits, you're paying tax twice. So you have to be really careful when you're trying to look at your income and your sourcing, and we've had people leave California before exercising certain things just to make sure that they're protected and don't get double taxed on something. I mean, thankfully it's a state tax, but California state tax is quite high, so it will add a lot of dollars that you have to pay into the governments and less in the individual's pocket. So it's something to be really careful of when planning as a comment, especially to a non-treaty country.
Yeah, and I think it's really ensuring people are aware, like avoiding those surprises. So even with California as an example, income earned in their registered retirement savings plan would not be protected. It would be subject to tax in Canada. So just really making sure that your employees are aware of what they're walking into is important.
Yeah. So just before we go to the question and answer and hold ourselves to your questions, the last thing here just to pay attention to is the best practices. It is super uber important to have a pre-departure briefing for all of the reasons we discussed before. If someone is leaving a country, talk to a professional who knows cross-border before they leave. It is way harder to clean something up afterwards than it is to plan into it. And if they don't plan into it appropriately, they can expose themselves to double tax, they can expose themselves to the punitive US foreign reporting and anti-deferral rules that they have in place now. So a pre-departure tax briefing, we have it number one because it's probably one of the most important things, not only for the employee, but the employer if it's one of your first people. I met with someone yesterday who is sending 6 people to Canada from the US, and they leave in 2 days. There's very little we can do besides quickly try and get some things in place for them for payroll, but for the employee, there's very little we're going to be able to do in 2 days for them to support it. But they waited until they got their visa. And then they're like, okay, we better look into this now. Look into it before you get the visas so that you have time to plan. Understand the residency rules. It is really important, if it's not already in your systems, if you have people going on comments, to ask them where are they filing as a tax resident. You should be asking your employees to ensure that you're not caught by them continuing to file as a resident in Canada and you're not doing T4s because you made the assumption they went to the US and are not a resident here anymore. If you're working with a global mobility group, we generally provide that information, but if you don't have a big population, then you might not ask those questions. Home in Canada, as Paula said, make sure you know if you keep a home in Canada, that's a pretty big tie to Canada, and so you have to plan accordingly for your employees if that exists. And then if they sell it after they leave, there's the clearance certificate and additional reporting that's going to be required. And the big one we have at the bottom here actually is delay green card. So many people go down to the US, get their visa with the intent to get a green card. We are not fans of that unless someone wants to permanently, it's a permanent resident, live in the United States. And the reason being is once someone gets a green card, and if they spend more than 8 years in the United States and then say, you know what, I'm gonna go back to Canada, now they're actually subjected to the US exit tax rules. And we think Canadian departure tax rules are difficult. Those are even more punitive than ours. And so and estate tax, which US estate tax is a lot more expensive than Canadian death tax. And so we really try to say, unless you are actually planning to never come back and you want to live in the United States for the rest of your life, just go on a visa. Stay on a visa for 8 years. You can do that. You can get different visas. We have one individual who was a green card, went down to the United States, then met with us afterwards, got their green card, went down and went, oof, and they came back to Canada right away, gave up their green card and are applying for an E2 visa because the estate tax would have just been like very punitive to them. Mm-hmm. So it's this pre-planning and thinking about it is important.
Yeah, it's a big one.
It is. So I think we got about 15 minutes here for questions, and shoot away, we'll do our best to answer them, but here's your opportunity to get us on the spot for any questions you might have.